Now, the next topic is performa financial statements. The main focus of the performa financial statements would be how firms plan for the future using financial information that is already given. Specifically, we will learn how companies use performa financial statements to evaluate whether their future plans are financially feasible. So here, what is really important that you will have to keep in mind is that pro forma financial statements are projected financial statements, and they're not recording. They're not about recording what really happened, but rather they are used to plan ahead so that companies could provide useful information to companies' investors. So basically, preparing the pro forma financial statements would help maintain consistency and makes it easier for investors to interpret the financial information. Now, then it goes on to a new concept called discretionary financing needed. So it is actually the amount of external financing the firms expects it will need to raise in the next year. So basically, preparing pro forma financial statements, one of the end goals of preparing or building those financial statements would be to figure out how much, like the amount of money that it needs to raise to plan for the future. So, in order to build pro forma financial statements, we first would have to understand a way to forecast sales because sales are the starting point for most of the financial projections and also for to build pro forma financial statements. So, a sales forecast usually would be based on a time trend analysis using what's called the linear extrapolation, and other items would be forecasted using what's called the percent of sales method. So these two methods, we'll try to take a look at them in the next couple of slides. Now let's start with forecasting sales. And the first question we would have to ask is whether there is a trend in sales over the past several years, or maybe to put differently, if there's a relationship between sales and the time. So to find this trend, we would have to estimate a simple linear relationship between sales and trend. And this relationship could be written in an equation like this: sales equals A, which denotes the intercept, plus B, which denotes the coefficient times X. And X here would be our time or the number or the year. And once we estimate this trend, we can make an important assumption that the historical trend in sales will continue into the future. And that assumption allows us to extrapolate the trend and forecast sales over the next year or the following couple of years. For example, suppose we observed sales from like 2021 to 2005. Okay, so this is our historical data. Based on that, we can run a regression of sales on years to estimate the intercept here and the slope or coefficient, right? And that relationship or that trend can be expressed as a linear equation, and extending that line or the relationship to the future, like 2026, 2027, we can estimate the sales amount for that particular future year, like 26 or 27. That's how we would forecast the future sales amount. And after After we forecast sales, the next step is to forecast other financial statement items. And at this point, relatively little additional data is needed for forecasting because we will apply an assumption or the method called the percent of sales method. In a sense, that we can use the sales forecast, the sales amounts, to find out a lot of financial statement items based on the assumption that they vary directly with sales. But there are some items that do not, and for those, we are going to apply a different method. So if there are items that vary directly with sales, then we would use the historical averages of the ratio between that particular item and sales, and we will assume that they are maintained in the upcoming years. What about the items that do not vary directly with sales? For those, we will just assume that those items may stay constant. There are some items, however, that are slightly different, but we will discuss that later on as well. And items depend on other things to decide whether they are going up or down from this year. Now, by combining the sales forecast with these assumptions and methods, we can build a full set of pro forma financial statements and evaluate the firm's future financing needs. Now, let's first start with the income statement side. The most common items that vary directly with sales would include cost of goods sold and sell and admin expenses. Items that typically do not vary directly with sales would include depreciation expenses and interest expenses. On the balance sheet side, items that vary directly with sales would include accounts receivable, inventories, and accounts payable. And those items that do not vary directly with sales would be almost all other items, such as cash, marketable securities, and all other like liabilities and equity section accounts as well. Now let's look more closely into how to forecast items that vary directly with sales. And for those items, we would have to remember this method, which is called the percent of sales method. For that, let's start with the cost of goods sold first. Suppose in 2024 and 2025, we observe the sales and cost of goods sold as shown in this table. And that based on linear extrapolation, forecast sales for 2026 would be 200. So this amount was just based on linear extrapolation that we saw in a couple of slides earlier. And let's suppose that this amount was given to you. And now, the next thing that we will have to look at will be the ratio between the item, which is cost of goods sold, and the sales. And to compute this this ratio of cost of goods sold, it will be the division between the 80 divided by 100, right? Then, the ratio would become 80% in 2025. But in 2024, it will be 60 divided by 80. So the ratio comes down to 75%, right? And the next step is to find out the historical average of these two ratios. And so that will be 80% and 75%, the average of these two amounts, which comes down to 77.5%. What we do next is then we apply this average ratio to the forecast sales in 2026, which was 200, right? Which would result in, so 200 times 77.5% would come down to 155. So what is this 155? This is approximately the forecast amount of COGS in 2026. That's how we forecast the amounts for items that vary directly with sales. So let's do this one more time with a different account, which is accounts receivable. So applying, these numbers, we're going to just use the same method once again. So the ratio between whatever item that we are trying to forecast for, right? So account receivable and its relationship or ratio with the sales. So let's just try to find that amount for each year. And that will be, so for 2025, the ratio between accounts receivable and sales was 30 divided by 100, right? So it comes down to 30%. And for 2024, it was 80 and 16, right? 16 divided by 80. That was the ratio between AR and sales. So that ratio for 2024 was 20%. Now we have to find out the historical average of these ratios. So 30% and 20%, it's the ratio between the average between these two numbers would be 25%. So we got the historical average. Next step is to apply this average ratio to the forecast sales amount for 2026. So if we apply this average ratio The forecasted amount for the accounts receivable for the upcoming year would be 200. The forecast sales times historical average, that would come down to 50. So our forecast amount for accounts receivable would be 50. So that's the method. That's basically what the percent of sales method is. Now let's turn to the items that do not vary directly with sales. While for most cases, a simple rule of constant numbers would apply, for certain cases, such as PP related items and retained earnings, you would need to learn special rules and apply them. Now let's start with PP and depreciation expenses then. Suppose depreciation expense was 80 in 2025. And note here that the sales information is no longer necessary, so it is not even given. Instead, we focus on any new depreciation resulting from PPE planned to be purchased in 2026. So if we plan to purchase a piece of fixed assets in 2026, which amounts to $500. And if we forecast that additional depreciation expenses incurring from this new PP purchase amounts to $50, that would have to be correctly recorded, and which would that would apply these three accounts in the performance statements. So on the income statement side, suppose in 2025 the depreciation expense was $80, then this new additional expense from this newly planned PP purchase, if it amounts to 50, you would have to record both, assuming that this $80 would continue to incur in the upcoming year. So existing depreciation expense and new depreciation expense, adding these two amounts, then your forecast amount for depreciation expense for 2026 would be 130. And similar thing would happen on the balance sheet side as well. So for the balance of gross UPE in 2026, the historical balance up to 2025 was 5,000. If we plan a new purchase amounting to 500, that would have to be added to the ending balance of 2025. So in 2026, it would amount to $5,500. For the accumulated depreciation up to 2025, the amount was $2,000. Now, if we incur 130 more, if we plan to incur 130 more in 2026, you would have to add that to the balance until 2025. So 130 plus 2,000, you would expect in 2026, the accumulated depreciation would amount to 2,130. So that was case one for the PP related accounts. And case two would be related to accumulated or additional retained earnings part, mostly on the balance sheet for the accumulated retained earnings. So let's suppose pro forma net income for 2026 was 50 and pro forma dividends for 2026 was 25. That means pro forma or forecasted addition to retained earnings would be 25. So in 2025, if your balance for accumulated retained earnings was 70, then the new amount of addition to retained earnings would be 25. So if you add that up, the forecast amount for 2026 on the balance sheet under account accumulated retained earnings would be 95. So these are the two special rules applied to case 1 and 2. And except for case number 1 and 2, most items, we usually just assume that these the numbers from the previous years would remain constant. Last but not least, let's just focus on the important concept of discretionary financing needed. A lot of times it's also called additional funds needed or required new funds or external financing needed. So what it really refers to would be the discrepancy between asset balance and total liabilities and equity balance on the pro forma balance sheet. So on regular financial statements, the balances are on under the asset side and liabilities and equity side, they would balance or they would match. But since on the pro forma balance sheet, all these items are just merely estimates for the upcoming year. They are not accurate values. Therefore, there should be a discrepancy between the assets balance and total liabilities and equities balance. So we try to capture this discrepancy or difference with the term discretionary financing needed. So in a sense, it's just the difference between asset balance and total liabilities and equity section balance. So let's suppose this difference or the discretionary financing needed was greater than zero, meaning it was just positive. There was more asset balance, more on the assets balance side compared to total liabilities and equity balance side. Then it would refer to a deficit situation. Whereas if it was a different, like an opposite case, DFN being smaller than zero, meaning asset balance was smaller than total liabilities and equity balance side, we would call the situation as a surplus. So this is something that needs a little bit of more understanding. So why don't we just look into that with this simple diagram here. So think of this, to better understand this, think of this left-hand side of the balance sheet as assets needed, which is a wish list of assets needed for the upcoming year. And for the right-hand side, which usually refers to the liabilities and equity or financing, financing, then this means financing needed for the upcoming year or the money that you need to afford the assets or assets needed or your wish list. Okay, so if you have a longer wish list compared to on the money that you can afford it, right? So this is your wish list and this is the money that you can afford it, like the financing. If your wish list is longer, then it means that you're in a deficit situation, right? So assets needed, if it's more than financing needed, then you're in a deficit situation. What about the opposite case? If your wish list is shorter than the money that you can afford it, or you can just, you can finance, then you are in a surplus situation. So this is basically what you need to know in order to build the pro forma financial statements and also compute the discretionary financing needed. This material is particularly important to take away as these will be used in your capstone courses as well. So please be sure to understand this material as completely as possible.